Oh, sorry, didn't see you there. Was binge watching House of Cards. What up, Hyperchange? Welcome to another episode. Today we're talking about Netflix. You probably all heard of it. Most of you guys are probably customers of Netflix, the internet's TV service. So they just reported Q2 earnings, blowout quarter. Revenue was up 32% to $2.8 billion. Yeah, $2.8 billion. On an annualized basis, that is $11.1 billion. Operating income was strong, up 82% to $128 million. Paid memberships, which is how many paying subscribers they have, at the end of the quarter was 99 million. 99 million Netflix accounts out there that are paying. That's a lot. That's up 24% year over year. So everything's going in the right direction. Very impressive growth overall. Now Netflix, for the first time ever, is projecting that its international subscribers will be higher than its domestic subscribers starting in Q3 2017. Right now they're neck and neck. About 50 million of the 99 are US subscribers, 49 million are international. They think next quarter that's going to flip. They're going to have 53 international, 51 domestic. And going forward, US subscriber growth was only a 9.4% year over year in Q2. And that's not because the business is bad or anything. It's just that they're reaching maturity. They have 50 million customers in the US out of 323 million people in the country. That's almost a 16% penetration rate. Almost 16 out of every 100 people has a Netflix account, and that's not including all the people who are using their friend's account. That just goes to show you that in a dominant, mature market, Netflix is able to reach 15, if not 16% penetration. Netflix is available in over 190 countries. So those 190 countries, minus the US, have a population of well over 3 billion people. Yeah, that's insane. So if they see the similar penetration as they're seeing in the US, in these other markets that they're already in, 15% of 3 billion, that's 450 million potential international memberships. They only have 49 million as of this quarter. So if you kind of look at this back of the napkin math, over the very long term, if Netflix continues its dominant position, they could easily, they could conceivably 10-bagger their international user base. So now all of the growth is going to shift to this international memberships. I think that's going to be the driving force of the Netflix story from here on, as it should. The company's just kind of reaching maturity here in the US, so now it's expanding heavily overseas. Netflix's business model, kind of tricky and confusing. A lot of people seem confused by the ever-rising stock price, even though there's been no profits, and this incredibly negative free cash flow. So what's going on here? First of all, let's look at revenue. Their business model is pretty simple on a very basic level, which is just you pay a monthly subscription service to be able to log in and watch all of their content. It's pretty much like a software as a service company. I call it TV as a service, but think Salesforce, think any of these enterprise software companies. The market loves to give a premium to these kind of companies because the revenue is predictable. It's easier to grow because you already have all the revenue from last quarter, this quarter, as long as nobody cancels. Then to grow, you just have to get new subscribers instead of starting from scratch every quarter. So it's a really cool business model and justifiably has a higher price revenue multiple than a lot of other businesses. The reasoning behind that at its core is that the software or the content that Netflix is giving to its users should be fixed in cost to make. If I produce a show for $100 million, that's a lot of money, and I spent $100 million, but I don't have to pay people I don't have to pay more money to produce it just to get people to watch it. So in theory, once they cover cost, each incremental subscriber that's streaming this content, they're getting an incredibly high profit margin. Now, what is that profit margin? We don't really know, because Netflix is amortizing its cost that it's investing into all this original content in its cost of goods sold. And they even note in their SEC filings that this is the bulk of their cost of revenue. So Netflix is only reporting about 30% gross margins, but the huge chunk of that cost is amortizing the original the fees or whatever they paid to produce that original content. Netflix kind of reached this inflection point maybe 5 years ago where they were like, okay, now we're actually starting to make money from this streaming business. Let's take all this excess profit and pump it into producing original shows, because this is going to give us an edge for the long term and let us be way, way bigger. And that has totally happened. It's exactly what's gone down. And the company is doubling down on this strategy. If you go into their Q2 letter and read it, I think it's interesting to note that they say that they're intend to be free cash flow negative for many years. Not even next year, not even soon, for many years. This year specifically, they want to lose between 2 to 2.5 billion. So what's going on here? Even though they're collecting billions in revenue each quarter from all of these paying subscribers, they're spending even more than that on original content because that's going to pay dividends down the road, they think. Getting more subscribers, getting them to pay even more, and eventually all of these new subscribers will outpace the amount of money they spend on content, and then all of that excess profit's going to flow to the bottom line. But we're not seeing that business model yet because we're still in the phase of them investing more than they even are getting in revenue into producing this content. I would argue if you look at the international expansion opportunity that we talked about, potentially going from 50 million to 450 million if they reach that 15% penetration of the population number, like there is a reason to invest in a bunch of original content. The bottom line is, if they want to keep growing in these international markets, they need to keep significantly investing in content, and so they're doing that. And I think that makes sense. So now we get to this question of how do you value Netflix? They're not producing free cash. They're not really producing much operating cash. Their revenue growth is very strong though. Streaming, excluding the DVD business, was up 35% last quarter. That was up from 32% in Q2 2016. So the core streaming business is actually accelerating. This is due to the fact that subscriber additions have been really strong and they're slightly raising prices. So like the core business is growing at over 30%. So even though it was at a run rate of 11.1 billion, as of Q2, it's still growing at 30%. I think that's incredible. Based on these projections that I've extrapolated based on Netflix's own guidance, I think they could get to 12 billion, maybe a little bit higher in a revenue run rate by the end of this year. So if you look at the $90 billion valuation they're trading at about 185 a share, that's about a 7 to 8 times price sales ratio of the run rate they're going to end the year at, which is not crazy when you compare it to other software as a service businesses. Look at Salesforce, for instance. They've traded about 7 times price sales. Go look at Splunk, Workday. Like all of these companies who have very sticky revenue models, they have recurring revenue from their customers, warrant significant premiums in the market, and this is why you're seeing Netflix, who has a very similar business model of that subscription recurring revenue, get a huge premium in the market. Yeah, so I think it's justified. I think this 8 times price sales multiple is totally in line with all the other enterprise software companies. And to me, I personally think like Netflix's business is way easier to understand. It just, like, I think they're going to keep growing. I think it's an excellent service. It's an excellent product. Their investments in original content have been incredible. I think they're going to keep killing it there. And so if you kind of add all that up, and like you assume that they'll grow 25% from that 12 billion run rate, we could be at a $15 billion revenue run rate at the end of 2018. And that compresses the price sales multiple to about 6x based on what they're trading at today. So the price sales multiple gets compressed really quickly because Netflix is growing so fast, and that's why it looks a little bit expensive. But I think given how early we are in the kind of runway of Netflix's overall growth, assuming they kill it internationally, it's totally justifiable to see them trade at a 7-8 price sales multiple, and that's why I think it makes perfect sense that we've seen Netflix kind of continue to make all-time highs as they continue to execute and grow revenue. Netflix's biggest competitor, Amazon. So this is kind of like the elephant in the room. I would say they have 3 big competitors: YouTube, Facebook, and then Amazon. And like the cable companies, they're all done. Everybody like Comcast, AT, these aren't real competition for what Netflix is doing, in my opinion. These other companies who are beginning, or tech companies, starting to invest in original content. Facebook said they want to fund multi-million-dollar episodes, cable-style TV, original content. Like they're getting into Hollywood. They see how big of an opportunity this is. That could be a threat long-term. YouTube launched its YouTube TV, kind of like cable-esque service. And then what they're doing with original content creators, I think is really special. So that's kind of the other end of the less professional market. But in terms of internet video streaming, I think YouTube also poses a threat in the long term. But the biggest one is definitely Amazon. Amazon has absurd amounts of money to spend. They're trying to push Prime Video as a huge part of the Prime service. Like I'm getting emails all the time from Amazon saying, make more out of your Prime service and use Prime Video and like watch all these free movies. So like they're really pushing this. And if you look at the content budget that they're allocating towards their videos, it's almost as big as Netflix. Like this is pretty crazy. Amazon is planning to spend $4.5 billion this year on original content. Netflix is going to spend $6 billion. And if you look at this chart, you can see Amazon's been catching up quickly to Netflix in terms of spending on original content. So I think this is like a very early long-term indicator of what will happen in the business. Whoever's spending the most and most like efficient spending on the best original content is going to have the biggest moat and the best service in the long term. So if Amazon can be smart about its investments in original content, keeps pouring a ton of money in here, they're going to be a very, very formidable Netflix competitor. But I think it's important to note, the way I see this evolving in the long term is you won't just have an Amazon, you won't just have a Netflix, you won't just have an HBO. You'll probably have all three, and those combined will replace what once was your cable package. So that's kind of the future I see playing out. The last thing is Reed Hastings. He's the CEO of the company, founded it 20 years ago. This guy is one of the best and brightest in Silicon Valley. Like, he's proven time and time again he could innovate and like kind of pivot the business model to where the future's heading. They were originally shipping you DVDs. They disrupted that. They disrupted themselves with internet streaming. Like, that's very hard to do, and how successful they've been with it is really impressive. And then on top of that, building on the streaming by investing in original content and how good they are at that has just kind of like really just Reed Hastings impressed me. So you have awesome CEO, incredible execution, a business that is firing on all cylinders. Like, I think they just have to keep putting one step in front of the other, investing in really good original content. And I think you're going to keep seeing them trade at this 7 to 8 price sales valuation multiple as long as the growth is above 30%. And I think it could stay there for another year or two. It'll slow very dramatically, maybe to the high 20s, low 20s as we get into 2020, 2021. That'll still be enough to justify a 5 to 6 times price sales multiple on sales that I think are going to be a lot bigger than. Netflix stock could still double from here in 2 to 3 years based on 30% growth and keeping the same price sales multiple. And I think they'll still be losing money. They'll still be growing. They'll still be investing in original content. It's also important to keep on your mind, when does the switch flip? When does this company go from burning cash to producing cash? Because eventually they'll have to do it, and they're getting pretty big. And although the international opportunity is massive now, in 3 to 4 years, I think Netflix's business reaches a different stage of maturity where we need to start seeing some free cash flow being generated to really start believing that this model will generate billions that they're going to need to justify the valuation in the long term. Let me know what you guys think of Netflix. You guys like the company? You guys hate it? Is Amazon going to kill them? Subscribe if you haven't already. That's Hyperchange. I'll see you guys next time. Peace.